Folks, welcome to the Contrarian Trader. This is Robert Desmond. It is Saturday, May the 7th, 2011. Let's get straight to the economic data that was released last week. And we obviously had a very rough week in the stock market, but when you take a look at the economic data that was released, it was a mixed bag. For the most part, I think it was fairly good. You had construction spending, which came in at 1.4%. The market expected flat, nothing on the construction spending. ISM index beat slightly, although the ISM services index had a big miss. So I will say that was a negative for the market. That was on, there was a services index on May 4th that was released. It came in at 52.8. The market had expected 57.4. So it's a very significant miss and well below the previous report of 57.3. So the trend in the services end is not going in the right direction. ADP also released their report, and it showed that in the month of April, the market had added 179,000 new jobs, which sounds good on the face of it, but in all actuality, it was a miss. The market had expected 200,000 jobs. Lord knows what the whisper number on the street was. The unemployment rate ticked up. Now we're above 9% again. Hourly earnings, that's a miss. That's a miss. There is no growth in average hourly earnings, and that's a kind of a forward-looking indicator. Average work week, which is a big forward-looking indicator, as an indicator towards the willingness of companies to add new staff. They will expand the work week. They'll offer overtime prior to putting on any new employees. That hasn't changed in the past several months. It came in as the market expected, 34.3 hours, and that's what the previous month was as well. So it doesn't appear as if companies are pushing their employees to work additional hours in lieu of adding new employees. Now let's get to the charts. Last week, if you will remember, you would have received each Sunday I put together the Contrarian Trader the Week Ahead Commentary. I sent that out to subscribers, and I mentioned that although after Bernanke's testimony, and he basically indicated, listen, there may not be a QE3, but there will be reinvestment, quote unquote, of funds into purchasing treasuries. And that'll run roughly about a third of what the Federal Reserve is purchasing now. Now let's remember that the long end of the yield curve, the Chinese have stopped buying. The Japanese can't buy because they now have to rebuild their country. So those are two major buyers who really aren't in the bond market buying back our bonds. So it's up to the Federal Reserve to create a market in our own bonds. Ponzi scheme, absolute Ponzi scheme. So that being said, longer term, I believe that they're going to try to rally this market as we go into the presidential year. So longer term, well, actually, I shouldn't say longer term. Intermediate term, I'm somewhat bullish on the market. Short term, were you a member last week, you would have gone into this week short. This previous week short. Why? Why was I so? What told me that this market was running into some trouble? Well, we had this great formation here. Stepping pattern, but last Friday, not this previous Friday, the prior Friday, we saw resistance at the 12,800 level. So we took it. Whenever we see resistance whenever we see resistance on the Dow Jones, we always want to go to the Dow transports, because the Dow theory dictates that as the Dow Jones hits new highs, so should the Dow transport. The problem is that the Dow transports had stalled. So that was indicator number one. You could see here in black this overlay, and the Dow transports here, there was a divergence. The Dow Jones proceeded higher as the transports began to top out. That told us that you could expect to see a correction in the stock market, especially on your large caps. What else? What else told me? Let's keep those shorts on and look to get even more short. The VIX. You're looking at the volatility index. The VIX was at multi-month lows, if not multi-year lows, and it hit the low 14s. So it can't stay there forever. When the VIX is low, you got to go. When it's high, you buy. So back here when it hit 31.28, you should have been buying the stock market. Back here, when it hit the low 14s, you should have been selling the stock market. What else? What else tipped our hand? Or tipped us to the fact that the market was going to correct. What you're looking at here is an overlay in black of the S&P 500, and here in red and black is the yield on the 10-year bond. For the most part, these two, the S&P 500 and the yield on the bond, tend to trade in tandem. They trade together. Whenever you see a divergence, as you saw back here, the previous week, not this week, the prior week, you had the stock market rallying as the 10-year bond yield corrected. That told us that the stock market was getting ahead of itself, and that for yields to go lower, that means that bonds must be rallying. Where is that money coming from? It's coming from the stock market. People taking profits out of the stock market, reinvesting it into bonds. So that's what you saw. And that's why we had our correction last week, besides the fact that the US dollar, I told my members, listen, this dollar is not going to go down forever. Get ready after listening to CNBC, you would have been shorting the US dollar for the past month. If you were a member and you were watching my commentary, watching my videos, reading my commentary, you would have known to watch the charts. Don't listen to these thugs on CNBC. They're not giving you valuable information. They tell you to buy a stock, but they don't come back on and tell you when to sell it. Or if they were wrong about a trade, they don't come on and say, you know what, before I start with this week's interview, I was on last week, I told you to buy Intel. It corrected. You know what, I don't think it's coming back. Sell it. No, they're not going to do that for you because they never want to admit they're wrong. Never. So it's critical to use charts. It tells you how the money is flowing. And if you watch my commentaries last week, you would have known I was getting bullish on the dollar because of all these doji formations and bottoming tails on the US dollar. It told us that the US dollar rally was imminent, and that would be negative for commodities and the US stock market. What else? Lastly, the banks. Overlay here, S&P 500 versus the banks. The banks are underperforming relative to the S&P 500. Yet you have the S&P 500 continuing to make new highs. Without the banks, it can't last for long. Just like you can't have the NASDAQ composite rallying for long without the semiconductors, you cannot have the S&P 500 rallying for long without the participation of the banks. It's critical. Take a look at Goldman Sachs on a weekly basis. Goldman is trading below its 50-week and 200-week moving average. That's a broken stock, folks. That's a broken stock. So the banks are weak. The dollar was going to rally. The VIX was low. You had to go. You had to take your profits on your longs and get short. Now, to silver. The silver trade. We got long of silver only because, and this is going to sound odd, but I ran a screen for shorts, and silver came up on that screen. That was here, back in early April. So early April, we had the silver pulled back against its uptrend line. And although it was at overbought levels, we knew that momentum stocks like this that hit my screens tend to go on to become extreme overbought stocks, meaning RSIs of 87 and higher. Extreme overbought RSI over 70, and there are other indicators that go into that as well. Silver in early April made that screen, and we said before we get short, we know that this is going to head higher. Let's get long. So we bought the SLV here. We rode it almost to the very top. We got out here on this neutral reversal day, and we took our profits and we got out. So the RSI was still well above the 87 level. We wanted to get short of silver. So to get that really big extra boost of being short, we bought the ZSL, the ProShares Ultra Short Silver Fund, which is about 2 times the move of SLV. And we bought that here on this doji formation on the ZSL. Again, ZSL puts you short of the SLV. And we have a huge profit in, well, we have a 100% profit on our remaining position right now. We sold half of our position here when we saw this topping tail, and we let the rest of the position ride. So we have a great profit in ZSL. So our short on ZSL worked great, and we're going to hold this position. And I will tell my members when to take profits and perhaps look to get long of silver. Now that you have everybody bearish on silver, you want to start to look to get long. That's how you're supposed to trade these markets. Right now you have massive liquidation because of the tightening of the margin requirements on silver futures. So they're dumping their positions, the traders, because they have heavy margin calls and they have huge profits. What are you going to do? You're going to take your winners off the table, and that's what they're doing. So it's too early to get long of SLV. If you want to know when to get long of SLV, join the Contrarian Trader. And if you want to know more about this trade that we did, I posted some video on that trade on the homepage. Go to the homepage, www.thecontrariantrader.com, and you can see it right here. Click play, and you will see it. Okay, folks, have a great trading week. Members, look forward to the week ahead commentary. It is coming towards you, coming to you tomorrow, being Sunday, Mother's Day. Happy Mother's Day to all the mothers out there. Husbands, get your wife some flowers. Be gentlemen, okay? Or else you're going to have a really bad day. Have a great trading week, folks. Talk to you soon. Bye-bye.